Hello, everyone. My name is Michael McClinton. I'm one of the business advisors with the Collin SBDC. For those that have attended one of these seminars before, thank you for coming back. For others that this is your first seminar, welcome. If you're interested in any of the other seminars that we're going to be hosting throughout the month as part of the CARES program, you can register on our website at collinsbdc.com/CARES seminars, as well as if you're interested in going back to any of the other seminars that we've already conducted, or even this webinar, you can go to our YouTube page. In about a week, all of our CARES seminars are uploaded to our YouTube channel, which will allow you to kind of go back and revisit some of the information that we've talked about. In addition to that, I encourage you to go onto our website and complete a CARES application for your chance to receive no charge consulting, or also be invited to one of the more structured programs to get an in-depth assistance with some of the challenges that you might be having in your business. Without further ado, I will turn over to our great speaker for this seminar. Her name is Margot Kottman, and it's on you. Here we go.
Thank you, Michael. Welcome, everyone. Hello, good morning, or good afternoon. For those of you, I think all of you are in the Central Time Zone. I'm still in Pacific morning time. Thank you so much for attending today's seminar, and I'm so happy you're here. My name is Margot Kottman. I'm the president of Project Retail, which is a boutique consulting firm that works with independent retailers all over the country. We focus on building profits for our clients by using dynamic cash flow planning tools, which is what we're here to talk about today. So today we are going to discuss the importance of building an annual cash flow plan and implementing a rolling 12-week cash flow. You will walk away with tools that will help you build and maintain a current cash flow for your business throughout the year. And I know those documents were provided for you. I will say, bear with me, this is my very first webinar. I'm a little bit of a behind the scenes kind of gal. So, forgive me if I lose my words for a moment. I'm a little nervous. So we will answer any questions at the end of the session. Feel free to ask as we're going through the presentation. Michael will make note of that, and we'll get to as many as we can once it's complete. So let's get started. So as you all know, we're here to talk about building an annual cash flow plan and then implementing a rolling 12-week cash flow. Just want to start with the very, very basics. Cash is king in retail. And often retailers look to financial statements for profitability where cash flow isn't necessarily measured. Both forms of accounting are important. One is managerial accounting, and one is really more for, filing your taxes per se. A paper profit is often a much different picture than your actual cash flow for many different reasons, but the biggest difference is your cost of goods sold versus your actual purchases. And so cash flow really is just a very, very simple calculation. It's sales, net sales, minus purchases, minus your fixed and variable expenses. So many of you and many retailers we work with, when analyzing their business, they focus actually on their net income on the profit and loss statement. And when it's an accrual-based business, this does not represent your actual usable cash. So what does this mean for you? It gives you a little bit of a false sense of profitability. And that's, a funky term a little, because you are profitable on paper. But what we really want to look at is, do you have cash to reinvest in your business? Why? Again, accrual-based businesses report on cost of goods sold, not purchases. And these are two very different numbers at different times of the year, with the ultimate goal actually for them to be similar, but it's not always the same number every single month. So cost of goods sold, COGS, as we all like to call it, is just that, the cost of the goods that you have sold. And cost of purchases is just that, the cost of goods that you purchased. So it's very important for you to track the purchases to understand your cash flow, because this is the actual cash out for that period of time on the goods you intend to sell. And, you know, as we all know, we don't always sell everything we buy. So in order to monitor the cash that you will have available to reinvest in your business and cash available to take out of your business for that family vacation you deserve once COVID, you know, goes away, or it's, you know, the vaccines are out, following your cash is crucial, and taking and tracking your cost of purchase is very, very important. So essentially what we've done is, or what I've done is break this up into multiple little expense buckets. And we will first start with our fixed expenses. So what you will find different here on an annual cash flow plan when comparing to your financial statement is your balance sheet expenditures. These include things like your accounts payable to vendors, credit cards, loan principal payments, or really your loan balances, and lines of credit, things like that. In addition to your fixed expenses such as rent, owner salaries, management salaries, any computer or website expenses, your utilities, any professional fees, your taxes and licenses, which is not to be confused with sales tax, and we'll get to that in a little bit. But here, what we just really want you to do is keep it very, very, very simple, and separate those fixed expenses from your variable expenses, and here's why. Your variable expenses are directly tied to sales. So as your sales go up, your variable expenses will go up, and as your sales go down, your variable expenses could go down. These include things like selling payroll, marketing, credit card processing fees, not credit card payments, not payments to your credit card company, but the actual credit card processing fees, commissions, freight out, freight in from your vendors. Those are all variable based on your sales. And so it's important to track these separately, because it actually makes the cash flow planning a bit easier for you. And we'll get to that when we get to the cash flow plan, the actual rolling 12 weeks, so you can see how you can implement the actual percentages that are tied to those expenses as a percentage to sales. So let's talk about the balance sheet, which is really the third important thing. And it's a very big, big thing for your retail business and keeping up with it. It's essentially gold. Because again, when we are looking at your P&L, you may often ask yourself, why do I show a profit of X amount, but don't have that amount of cash in the bank? And essentially you will find that answer on your balance sheet. Certain balance sheet expenses, and I air quote here, do not show up on your P&L financial statement, as I said before. So it's crucial for you to maintain a current balance sheet and track the payments out, so you can see how your liabilities, credit cards, vendor payables, loan principal payments, how those go up or down as you pay off and potentially use the credit again. So as I mentioned earlier, if you have long-term liabilities, those are and should be considered monthly fixed expenses, especially when it is a long-term loan, and it should always be built into your cash flow projections. Credit card payables and accounts payable, like to vendors and things from previous years in business, won't necessarily be reflected in your current year expenses or purchases if for example, you put your inventory on a credit card. So, any payments that you make on the credit cards or to the vendors with terms will need to be separated out as weekly, monthly, annual payables. Uh, the the goal here is to obviously see the debt go down and be reduced over a period of time. But as we all know, since we reinvest in our business on a regular basis, on a monthly basis, in certain times of the year, based on the peaks and valleys of retail, it isn't often the case. So again, it's just all about tracking, all about keeping your financials up to date so we can use them to essentially build the 12-week cash flow. So first, guys, we would like to build, the annual cash flow projection. And so essentially, we break this up into 3 little buckets, and you have the working document that will help you outline your annual expenses. And what is good to do is once your financials are closed for last year, even though last year was a little tricky, my suggestion is to take, the last 90 days, maybe all the way to 6 months out to average essentially what your expenses are monthly and then break it out by 12 months. And so we can get a year's picture. So I've got a little snapshot of the individual pieces to the puzzle broken down into 3 areas. So the top line is your revenue. Okay. It is definitely important at this point to split the revenue from your e-com and your brick and mortar if you do have the e-commerce revenue source going on in your business. Does not matter how small it is, because eventually you want to also potentially look at any expenses that are tied to running the e-com business as a percentage to sales. But for now, everything goes together, but it is definitely important to track both in-store brick and mortar revenue and e-com revenue, okay? Purchases are here, and that again is not cost of goods sold, so you will not find that on your financial statement. What you should do is pull a purchases report out of your inventory management system and understand how much did I spend over the last 12 months, 6 months, or even 90 days, right, against what I sold, okay? And understand that as a percentage to sales. So you'll see here cash margin dollars, okay? So cash margin dollars is a very, very, very simple calculation. That is just revenue minus purchases. So when you bring in your expenses, okay, you will then get your cash flow. So cash margin is just simply revenue minus purchases. Cash flow is revenue minus purchases minus your expenses, okay? So you can see that we've broken up the 3 pieces: fixed expenses, variable expenses. But the actual really beautiful thing is coming next, which is the full document that basically outlines how everything is related as a percentage to your sales. So let's run through the simple math, right? From the first slide where we basically went through what cash flow is. So we're going to break it down by percentages. So sales is always 100%. Okay, 100% top of the line. Purchases here in this example is 52%. Your expenses from this document is 37%. So 100 minus 52 minus 37 equals 11. So your cash flow is 11%. So you will see here that there is an expense percentage next to each line item, each expense here, okay? So there are industry standards for things like rent, payroll, credit card, processing fees, marketing and advertising, your freight in. So a really good exercise to do is to go through and check your expenses. First build this as, your reality and what is actually happening in your business. And check to see if they're above or below the industry standards. When you're looking at your business and you know that your purchases are a certain expense, your expenses, or I'm sorry, a certain percentage, and your expenses are a certain percentage, you want to make sure that there's something left over, right? There's a cash flow percentage left over. So essentially, if your expenses, and we like to use a little bit of a rule of thumb, if expenses are greater than 40% of your sales, we really need to look and dive in and understand what's going on, right? Where potentially are they too high? Where are they potentially too low? Where could we do better? Okay. One thing I do want you to notice here is that sales tax is not included. And I really believe that, and it's true, when you think about it, is sales tax just isn't our money. So it really shouldn't be reflected as income, and it shouldn't then be shown as an expense on your profit and loss statement. So I suggest always that retailers put the sales tax that they take in, whether it's weekly or bi-monthly or just once a month, whatever you take in for sales tax, and you can get that number by running a report out of your POS system if you have one, to say, okay, I sold $10,000 this month and our sales tax is 10%. So I need to put $1,000 aside to go ahead and pay that, right? One of the things that's really interesting is sometimes we don't save it and hold it and we use it as if it's our money. We get it. You might have to, no big deal. But at the end of the day, nobody really wants to pay those big penalties for late sales tax payments. So tracking that, right, and really looking at net sales as opposed to the gross sales is important, I believe. And you will find that sales tax is a liability, actually a short-term liability on your balance sheet if your balance sheet is up to date. Okay. So this is just the main sort of Bible document per se. And what you can do is you can update this as business is happening, quarterly. Some people like to do it quarterly. Some people like to do it, every 6 months. Some people just like to do it once a year. Completely up to you. If business is really just, staying pretty flat to what your projections are, you can kind of hold off on doing it quarterly. But if you wind up starting to grow and start beating your projections, I always suggest, let's reforecast. On the flip side, if for some reason business isn't what we had hoped, and we've learned that last year in a very, abrupt, difficult way, you always also need to redo the annual cash flow. Okay. So now to the fun part. Taking what we just reviewed and incorporating it into a 12-week cash flow document. Okay. And I'll just back up and say, I really, really like to keep everything simple. This doesn't seem simple, right? I understand. But I think if you take deep breaths and just say, okay, this is where I'm going to start. Let's break it up in 3 chunks, and we can then build the actual 12-week cash projection that's going to help us understand, how we can potentially pay back and service any debt. When will those credit card balances get paid off? Things like that. Okay. So I get asked often, and I did want to touch on this, and it might be a question, but I do actually get asked often if it's okay to do this monthly instead of weekly. I have found that weekly is a better way to do it, just to stay on top of what's coming in and going out, sales and inventory and and expenses and all of those things. Because in the event of a pandemic, which happened to us, it is very important to just kind of know where you are at right at this moment, regardless of where you want to be, right? So it's one of those things that, if we want to be somewhere, how are we going to get it? But if we don't know where we actually are, it's going to be harder. And we do this actually because what I have found is we're usually very quick, and when the year ends and after the holiday season, which is typically a good season for people, and even this last season, and you wind up with a chunk of cash in your bank, more than you've had let's say in third quarter. People are very, very quick to pay off debt, right? Credit card balances or even lines of credit or what have you. And what we don't know, if you're not implementing some sort of cash flow forecast for the next 12 weeks, is that we don't really know if we can afford that, right? To take the cash out of the bank, the operating capital, to pay down the debt without actually going back into debt. So sometimes, keeping balances when you have credit and you're current and all of those things is not a terrible thing. I know it sounds scary. It's scary for me. It's scary for, all business owners, I think. So we just simply want to be prepared, right? This has been and continues to be this document very valuable as we navigate through COVID. So what COVID did was force many retailers like yourselves to dive in and really get a true picture of where you stand and how to stay ahead. Many of whom ended 2020 with more cash in the bank, right? Many of them, actually, they had more cash than they have ever had before, even if you take out some of the government funding, right? The SBA loans, the EIDL money, not the PPP, because, a lot of that's forgivable, but, the EIDL money, this is even after that's removed, their cash was much better. And simply, it was kind of one of those things where it was more so, and I have one client in particular where she was forced, right, to actually understand what was she paying for every single week, every single month. And it was interesting because one day I got a phone call and she said, oh my gosh, I've been paying 2 renewals for services that I don't even use, that I thought were canceled. So this is why we do this, right? Even though it looks complicated, again, we're going to try and keep it simple. So we basically break it up just like we do the annual cash flow into sales, income, inventory purchases, balance sheet payables, weekly expenses, okay, fixed and variable. So when you write your rent check, right? So you plug that in the first week of the month or the second week of the month, what have you. So let's go ahead and look at the blank sheet. So what I've done is basically provided, and you all have the presentation in your hands, is provided essentially the blank template for you. And then we'll go in and look at an example of how people use it. Okay. Okay. So let's walk through the basics. So this is a couple things to note. Do not fill in the pink cells. Okay. And do not fill in the ending cash balance. So I should have highlighted that pink when I was doing a run through last night. I was like, oh boy, I forgot to highlight that pink. So, you guys, if that would be helpful, let me know, let Michael know. I can resend a document if you think it's really helpful to highlight cells in the pink, so not to fill it in. And do not fill in, okay, the cash in total, right? Same thing. Only fill in the retail sales store and retail sales online, and then all of your expenses that are below. So I started essentially a little list for you. Please feel free to delete and completely start over. Just enter in all of your monthly expenses there. So in the green, okay, up at the top in regards to the cash, so you're going to start, day one. So I always suggest starting on a Monday. That way you can, capture all of the week's sales and have a nice, understanding of what your cash balance is, the Monday morning. So first week you will enter in, next to week 2, you will enter in the very top line starting cash balance. You will enter your starting cash balance there. This number is basically a clean number that's operating capital, okay, that you have to use. Some people, okay, bear with me, but some people don't like to include their savings, okay? If you have a stash of cash, or if you have a line of credit, some people don't necessarily like to include that. Some people do. I think to keep it very simple, absolutely just plug in the amount of cash that you have available, no matter if it's tied to a line of credit or a savings account or what have you, so we can see how the next 12 weeks play out, okay? Right underneath that, I highlighted in green, your actual cash balance. So this is a checks and balances, okay? We want to monitor for the first few weeks how the calculated ending cash balance looks next to what is actually available. And again, just simply a checks and balances situation. Are we doing this right? Was there something missing? That type of thing. So I also suggest putting the big expenses first. Rent, payroll, inventory purchases, any loan payments, anything like that. I like to sort of go from top to bottom, big expenses, and then drill down. So without further ado, shall we actually look at an example? Next. Okay. So you will all notice some yellow highlights in here. So I want to actually start with that because essentially what this client does that has been very helpful is highlight yellow actual numbers in sales, okay? And then highlight the actual numbers in the cash out to know that it's cleared the bank, right? So it's basically helping you with the checks and balances system to make sure that we're doing this right, okay? If your actual in green, okay, is a little different, give or take a few $1,000s, positive or negative from the actual calculated, it's okay. I don't want you to spend your time backtracking and really focusing on where did I go wrong. If it is, over a few $1,000s, I think we definitely, should check that out. So you can see, especially, and I really actually want to touch on this in the sales section. So you can see that next to week 24 in week 25, this client actually, you have clean numbers for sales goals, right? And those, when I say goals, that is exactly what they are. So in that area, what you will do is you will put in your sales goal for the week, right? And then once the week has actually occurred, you will then put in what you actually sold. Remember something. This is a net number, okay? So if you are reporting gross, often what can happen is you'll start to see the actual and the calculated balances get a little off, okay? So net sales is what we're looking for, okay? And then you can see down below that in some cases, checks actually got deposited and cleared before the week was over. That's okay. Leave them where they are. It will work itself out. Okay. You can also see, my friends, that there were a couple weeks where unfortunately she couldn't keep up. So it happens. Don't beat yourself up about it. Maybe you went on vacation, maybe you were sick, maybe it was the holidays and business was crazy and you just couldn't keep up, which is a little bit of what happened to her. So, just simply be patient. So one thing to also note is if you have outstanding checks, let's say from last week or this week, right? And you're going to start this on Monday. You should just simply create a line item, right, under expenses and put in there the total checks that are outstanding, assuming they will be cashed, next week if they haven't been already. All right. And that might be something you have to play with for a little while. If you do write a lot of checks, if you do more electronic things, then it should really be fine, and next week you can start from scratch. Okay. So, I've been asked about, what the key to success is in maintaining this, right? Because it seems a little daunting if this isn't something you've ever really tracked before. And again, I'll go back to keep it simple, even though it's doesn't necessarily seem that way, but keep it simple. And every 2 weeks is when I would add another 2 weeks. So, you can see here that she did not add, out another 12 weeks. So, she fell behind a little. Fortunately, because of the season for her, we built cash, but we also are coming into Q1, which is really slow because it's wintertime and it, just wah sometimes. So, I drilled in on her and said, hey, we need to add some more weeks. So the other amazing thing about creating the annual cash flow with the expense percentages to sales is when you get to your variable expenses, okay, things like credit card processing, selling payroll, if you need to budget for your payroll, for the month, and you have a sales projection, and your selling payrolls around, let's say 10% of sales, then you can budget that accordingly. So my suggestion is to take the first annual cash flow, and then when it comes time to get to your selling payroll or your marketing expense or what have you, even your credit card processing fees, enter those in weekly by using the actual expense percentage to sales. Okay. So for example, if your credit card processing is 2% of sales and you sell 10,000, to put $200 in that line, or I'm sorry, did I just goof up on math and I do math for a living? 10,000 times 2%. You get my drift, hopefully. I need a calculator. Not good on the fly. So basically take the percentage, multiply it by what you've done or what your sales goal is and stick that in there. The other suggestion that I always have to really get a handle of how we want to run the business moving forward, right? Forget about the past, let's move forward. Is how much cash, operating capital, do you want in your bank for a cushion? So, my rule of thumb and suggestion is really 2 to 3 months of your fixed and variable expenses. That way, if there's a higher burn rate than anticipated due to something out of our control, like a COVID situation, we can pivot and make adjustments as necessary. This is actually a rule of thumb and really helps you kind of understand, and it comes full circle a little, of why paying down a credit card, a big credit card balance, is important not to actually do until you understand what the next 12 weeks look like, just in case you might need that cash again. Um, so if you can afford it over a period of time, right, we want to know that. And we also want to be mindful of, yes, we have a credit card balance and it has a certain interest rate and all of those types of things, but we also want to put in a realistic payment plan based on, what kind of cushion you want, what kind of business we think we're going to do, what expenses are tied to it, and then what's left over. Okay. So I know I kind of went a little fast because I'm a little nervous. But at the end of the day, cash is king. And you want to follow it, you want to understand it. And if you can't wrap your head around it, you want to ask for help. When I owned a store, I did not do any of this because I simply didn't understand it. And as I evolved, and started to understand it more, it was easier for me. Sometimes you're too busy, right? You might not be good at it. So, just always ask for help. The key for you is to always, always, always have accurate and current financial statements to reference back to, no matter what, even though those don't necessarily follow the cash, they do follow your expenses and as they're accrued along the way. Uh, Getting too far behind sometimes puts us at a deficit because we don't necessarily know what we've paid, what we are need to pay, what's current, what's not current, and all of those things. The power in cash flow planning really came to light this last year in 2020. And when the SBDC called me, it's interesting because we were shifting at the time and really sort of flailing and trying to wrap our heads around what was going on and all of these things. And then once we took a deep breath and sat down and said, okay, what does this look like and how can we move forward, in the short term to then hopefully, come out on the other side, was really, really, really following that cash. And it's powerful. It's very, very, very important. And, I think, again, keep it simple and try to understand it. But just remember, if you don't measure it, you can't improve it. And knowledge is power. So that basically concludes our session today, this little slideshow. I open the floor for questions. I really appreciate it. Thank you for being patient with me being possibly quick. And Michael?
Hi, Margot. So a question came through the chat. If you are using QuickBooks, how important is it to use the cash flow spreadsheet in Excel?
Oh, that's a great question. So if you are reporting on an accrual basis and you're keeping track on an accrual basis, you can often actually flip the switch in QuickBooks that will show you the cash. Okay. So you could, and I haven't seen it done necessarily successfully, you could flip the switch to cash and then export the QuickBooks cash flow and use that, or use what's in it and then, incorporate that into the actual cash flow document. 99.9% of my clients, actually, I would say 100, use QuickBooks, and they're referencing back to it. But what it doesn't necessarily do is predict the future. So if you do keep a great QuickBooks record and, most of your expenses are in there and accounted for on a monthly basis, it can really actually help you fill in the next 12 weeks, like with rent and when payroll's coming out and all of those types of things. And it can also, in QuickBooks, when you run a P&L, you can actually click a little filter on there that will tell you the expense percentage to sales. So that is very helpful as well.
All right, if anyone has any additional questions, feel free to send them in the chat. And then Margo, I have a question here. Should I take out a line of credit to pay for my inventory or cover it with a credit card?
Great question. Do you, well, actually, the big question about that is what kind of credit can you get on the credit card? And what is the interest rate? Line of credit interest rates are better, typically. Usually you can get them under 5%, where credit card, those interest rates can be sometimes up in even the low 20s, depending on what your credit is. Now, if you can get a balance transfer, or if you can open a credit card where they will allow you to carry a balance for a certain period of time, interest free, that's not a bad idea. I would say you could do a combination of both potentially, but it's really all about that interest rate. Keep that interest rate as low as you possibly can, as low as you possibly can.
So it doesn't look like there are any additional questions. Give it a few more seconds. So it looks like one more. So with cash flow, how would you recommend handling the slow seasons?
Great question. That's actually why we do it. So when we understand, right, new inventory, I didn't necessarily touch on this, but new inventory drives business, right? Drives sales, regardless if, the peaks and valleys. So we always want to have new product coming in so our customers, have a reason to come back. So often what happens is because we do have a set amount of fixed expenses, right? That no matter what, this is what we have to pay. We essentially need to understand what it is that we need to sell over a period of time, and then also buy, right? It goes back to the purchase percentage and the expense percentage to sales. So knowing that the fixed expense isn't necessarily touchable, but the variable expenses are something that are, really directly tied to our sales, then we can project out how this looks over a period of time. So that's actually, right now is, for some of you, this is that time of year. It's really slow until, springtime and the flowers start coming out, and and not to mention that there's also COVID going on. So what the cash flow will help you understand is what do I actually need to sell to support bringing in new inventory and to pay my fixed expenses, and then the variable expenses that go against the sales. And it actually will help you back into really, what your break even point is for that month, or that 6 weeks, or whatever the time period of your downtime. A good example actually is when you're a more seasonal store, and the first, I do have a client actually comes to mind that is this way, and it's actually the example that was on the document. Essentially, the first 9 months of her year are tough, and then the last 3 months is when she cashes out. So we have to be very, very, very diligent in those first 9 months, and really understanding what is it that I need to sell to pay for those bills. Yeah, so you can almost back into, what is it that you need to sell. And then to take it a step further, not to push or promote the next session, but the inventory management and sales forecasting actually comes into play there, to really actually in those slow times figure out, okay, well, if I need to sell 25,000 and I've only been selling 15,000, how am I going to get there?
Thank you so much, Marga.
Mhm.
And that actually concludes all our questions. So again, thank you everyone for attending this seminar. Make it a point to go onto the website to see when the next upcoming seminars that interest you are happening. I know that Margot will be back next Wednesday. I want to say the date is, let's see, the 27th. So if you want the next session within this retail kind of cohort, you can register to attend next Wednesday. All right.
Yeah.
Thank you so much. Have a great day.
Thank you. Have a great day.